Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for May 11th of 2025. We have quite a few charts to get through today, so a lot of these are going to be kind of rapid fire, some quick observations, and then moving on to the next slide. So here we have US GDP in the green line here. We can see that the estimates are clearly coming down at the same time that we have inflation expectations that are moving up. This represents the consensus forecast for 2025. So overall growth now looking around 1.5, maybe 1.2, 1.3%, whereas inflation due to the tariffs that have been announced right now looking closer to 3%. Again, core PCE at 3% is not necessarily a bad thing. We have seen trend line estimates that were much lower than that as inflation was coming down, but obviously here with the announcement of Liberation Day and the tariffs, we've seen a fairly sizable change in a fairly short period of time. Here we have economic growth expectations kind of represented in a different way. So this happens to be the Peterson Institute for International Economics, and this just gives you a kind of a sense of the cadence and the progression of this downturn due to tariffs. And again, obviously, as we very well know, the whole backdrop on tariffs could change and evolve in a very different way very quickly. So I want to be careful not to like etch these into stone. But as it stands right now, Q1 2025, I mean, this is real GDP growth that we've already had the first reading here, and it was slightly negative, but likely to be revised up here, but maybe not 0.5, but this is just the estimate for Q1. And then that goes down, and you see the real pressure comes in Q3 after we get past all of the dislocations of people buying in inventory ahead of the tariffs, consumers spending ahead of the tariffs, and then once everything kind of settles in and you start to deal with some empty shelves and things like that, then what you see in third quarter is probably the trough of the issue at hand. And again, I'll say, tariffs and inflation, the real quick read on that is that, when you have tariffs that get implemented, you have a kind of a one-time adjustment in prices. They go up by virtue of the tariffs if the delivery mechanism is not able to absorb those price increases, they're going to pass it along to the consumer. But then after that, you really don't see consistent rises in inflation. The rate of inflation goes down, but your aggregate your price level has gone up, and that's going to impact your demand curve. But that being said, third quarter likely our trough, and then the economic backdrop begins to look better sequentially into 2026. On this slide, we have a trend in Port of LA activity. This is container volume deliveries into the port, and just as to remind ourselves that the Port of LA, the majority of its shipments do come from Asia, and very many of those obviously come from China. So what we've seen here, and this is on a year-over-year basis, we had a lot of activity ahead of the implementation of the tariffs, but after the announcement of this Liberation Day, if you will. And then really the last 3 weeks, we've seen a pretty soggy environment with regard to container volumes in Port of LA. And in particular, on a year-over-year basis, we were down like 36% on May 4th. So you can see that there were some advanced shipments ahead of the tariffs, and then where we stand, like even in the most recent week, very, very much flat year over year. So we're seeing an environment that's really kind of soggy now from a container ship delivery. We know that sailings are way down. And so again, just to remind you of what we talked about over the last several charts of the week here is that, if you have less container activity, then you need less trucks to transport all those goods once they get to land and get to port, and then you need less workers, and then so on and so forth. So there are second derivative impacts to the degree that container shipment volumes remain depressed as they are now. Well, as I'm recording this here on a Sunday, we do have our Secretary of Treasury, Scott Bessent, over negotiating with the Chinese in Switzerland. and some rhetoric coming out of the presidential fold yesterday is that the expectations are that maybe we'll get something closer to an 80% tariff, but something clearly a lot lower than what has been announced. And just to be clear, anything like 140, 150, I mean, basically you're signaling you're going to cut off all trade, and that's just not tenable because there's no way you can move supply chains. You can't move manufacturing quickly enough to satisfy that demand. And so, probably will be interpreted positively by the market tomorrow. We'll have to wait and see. But some rhetoric now that tariffs are going to be much, much lower than have been announced previously. Here we have S&P 500 revenue from China. This is a really impactful slide when I read it. Now, we talk about the trade imbalances and the need for some negotiation. Again, I'll argue that we don't need a blunt instrument as we've had over the last month, but I do feel like, that there are trade imbalances that need to be addressed. Well, what we're talking about with China, U.S. trade deficit with China is $295 billion here. And then, but to put it all in perspective, the S&P 500 revenue from China is almost 1.2 trillion. So when we're talking about the relative impact of policy decisions that impact economics for major U.S. corporations and U.S. business in general, this is a very powerful number relative to the overall trade deficit. On this chart, we have the International Monetary Fund, and some of the estimates, some of the work that it's doing to gauge the impact of tariffs, and this is a revision. Basically, these are the net revisions from their pre-tariff forecast to what they see for 2025. And very clearly, you see the United States has the largest impact, followed by Canada, China, Japan. You can see the UK, which there was at least the agreement to finalize terms of a trade deal with the UK, even though 10% baseline tariffs are going to remain. You see the downward revisions there. And so Spain really is the only, I guess if you could call it a net beneficiary of these revisions from the IMF, but clearly U.S. taking the brunt of the issue here. We want to talk about small businesses too, because it goes without saying that the overwhelming majority, I mean like 98% of businesses in this country are small businesses. I mean that's what the backbone of the U.S. economy rests on the shoulders of, and you can see job openings and the labor pool and the sustainability of the strong labor market that we had going into all of this mess. Small business represents a tremendous amount of job openings, and again, that's weighed against these mega S&P 100 firms that employed tens and thousands of, literally hundreds of thousands of people in the case of somebody like Walmart. But basically 75, we'll call it 3/4 of all job openings are in the small business sector. And then obviously when you get up into these very large firms, it represents a very small number, and you could see that maybe this number is going up a little bit just in terms of going from 2020 in February to 2025. You can see that basically the texture remains the same, but when you're talking about the smallest companies up to 250 employees, you're talking about a lot of job growth there that could be impacted if you make it harder for people to do business, or harder for them to be competitive, or harder for them to access capital, so on and so forth. On this slide, we have the actions that companies are taking in response to higher tariffs, or at least what they're saying that they're going to do. And this one is most notable here, particularly in the manufacturing side. So we've got manufacturing in green, services in blue, that they fully intend to pass those costs on to customers, particularly on the manufacturing side. You can see, and that's weighed against a smaller percentage that are saying that they are planning to absorb the cost increases. And again, I think that's a desired effect because you want to maintain price competitiveness if you can, and protect and perhaps even gain share in a rising price environment. But this has a law of diminishing returns. At some point, you begin to really eat at your margin if you're eating a lot of cost without recapture. And at some point, this, I think, will hand off to passing those costs along. But you can see some of the other things that are notable that are going to take time, obviously. Finding new suppliers, whether they're domestic or foreign. And moving up purchases, I think we've already talked about that. We have certainly seen that in a lot of cases. And then this is kind of the more macabre scenario where you've got businesses that are going to be scaling down or actually closing. And sad to say, but the degree to which we see this whole aggressive tariff regime remain in place, that these numbers are apt to move higher. But just interesting data to gauge or get a sense of what small businesses and businesses of all sizes are thinking in response to tariffs. I find this slide to be pretty interesting here. And so when we talk about export volumes from the U.S., there's actually a fairly strong imported content within those exports. So just say that there's raw materials, and there's there's components that are fabricated overseas that are then shipped to the U.S. that are then integrated into final products. And you can see here, this box happens to isolate motor vehicles, trailers, and semi-trailers. And just think about, they're auto components that are shipped to the U.S. that then get exported out. Now, all of this is going to be impacted by tariffs. So obviously our exports are impacted by retaliatory tariffs. And, to the degree that, we'll just look at this one sector here as an example. And again, electrical equipment, textiles, mining and extraction, rubber and plastics. I mean, these are major industries here that all have a pretty high degree of foreign value added in those exports that are all going to be impacted by tariffs. So just say that, when you go from 95 to 2020, on balance, the amount of foreign content has actually gone up. So this goes back to my longstanding comment about tariffs, that you got to be really careful about how you use these things. And I really just don't like the blunt instrument that they're being used, the context in which they're being used right now, because this slide alone just confirms that that it is easy to bite your nose to spite your face. So another area that's of keen interest to me is the pharmaceutical industry, and here you can see that when you look at some of these, very key areas of the call it in this case the pain and then the infection management side of the pharmaceutical business, that we get a lot of these things from China, and we put ourselves at a very competitive disadvantage, and there are obviously cost reasons why we do this, but from a national security standpoint, if you've got basically almost all of your ibuprofen, most of your hydrocortisone, and then you get down even to penicillin, which was invented in the U.S. And created in the U.S. And so volume production is largely being done overseas and in China, which is in the direct crosshairs of our trade negotiations right now. It's just one of the many areas that you got to watch out for the unintended consequences of the actions of slapping on these 145% tariffs on key trading partners that in this slide alone, tell you how important it is to get it right when you're talking about trade and trade negotiations. So to couple with that prior slide, we can see here very clearly that we've had a very large spike in imports of medicines, pharmaceuticals. You can see pharmaceutical prep, including vitamins. So, everything that was in that last chart, I think it's clear that, a lot of folks are building inventories ahead of these tariffs, not knowing where this whole tariff issue is going to go. On this slide from Apollo, we have the import share from China. And we've talked about this in the past. And when you look at these key categories, and it seems pretty benign on its face, but baby carriages, uh, and you've got flowers, artificial flowers, you got umbrellas, desk accessories, stainless steel water bottles, think, not necessarily Yetis, but other things like that. And then, some, even baseball hats. And you just look at 90% of these products that we take for granted in our lives, uh, you know, that a lot of these things come from China. So again, you got to watch what you ask for, because you find that they're going to hit you in a lot of areas that you're really not thinking about, but could be impacted quite significantly if we don't work through some of these negotiations. So interestingly enough, with China, which does have a lot to lose in this trade battle with the U.S., and you can see that exports by destination to the U.S. We've already talked about container ship volumes really dropping off a cliff here. So what's interesting is that don't count China as having one foot in the grave just yet, because while these exports to the U.S. have gone way down, they've actually gone up in other areas, and particularly into the EU and Latin America and the whole Asian rim. We've seen net increases, basically, looking at essentially 1 month. So a quick kind of more of a comment here than really anything else. So, that there are upside risks to U.S. inflation, as we've talked about, kind of a short-term or one-time reset in price levels, which would be inflationary. But what happens here is that you've got in U.S. inflation going up, which is going to impact the dollar, which actually means that elsewhere in the world you have deflationary pressures, and in particular areas like the European Union, and also Japan, Australia. So there are offsets, and so the opportunity in some respects is that if you can find good investment opportunities that help accentuate maybe what this is all showing us here, that if we do have that cost or that price offset, with tariffs, that there are going to be probably some net beneficiaries from just a pure price standpoint. This chart, real quick, shows you all of these different areas here that are beginning to see input costs over the last month. You can see, there are a lot of services here as well. So, and let's not lose sight of the fact that services are a much bigger part of our economy than the goods sector is. And so when you see services witnessing some changes in input costs, you obviously take note, but clearly input costs have gone up at a faster rate than the output charges, i.e. prices are. And so that's going to be a challenge for people to keep up with these things. And it gives me not a tremendous amount of confidence that we're going to be able to hold our margins here, which in turn could put, some earnings of S&P 500 and the other stock indices at risk. But to that point, a lot of those estimates have already come down to kind of adjust for this issue, and we'll see that in just a few moments. So I have another chart here that kind of speaks to the law of unintended consequences. So ironically, U.S. automakers are some of the biggest importers, and this is auto imports into the U.S. You got GM, obviously Toyota, Hyundai, Stellantis, which is the old Chrysler, or part of, has Chrysler embedded in it, but Honda and Ford. So so these represent not only finished cars, but also intermediate produced inputs into cars. And so let's not lose sight here again to the law of unintended consequences, that you've got domestic producers that are actually pretty big importers as well. Now, I just mentioned that services is very important to the U.S. economy, and so this is a chart of the trade balance of export services, and you can see that that turned negative for a couple of months here, and the latest reading was down, call it slightly. I mean, we typically run a pretty dramatic trade surplus in services, unlike manufactured goods, but it was down here in the last reading. This chart from Pi, I think, does a really good job of talking about like whether you have a 10% tariff regime, 15 or 20%, that you may get increased tariffs on imports, but that is offset by losses in tax revenue from basically lower activity in some of these other areas like household, like personal income tax, corporate tax. And so, maybe you get a net increase, but it's a lot less than what you think it's going to be. Okay, we're talking about the Fed now and the probability of rate decreases. And as I think hopefully will convey to you, I think the prospects are probably likely, more likely perhaps when we start to see the hard data soften up a little bit, that being like orders and like actual shipments of goods and contracted services and things like that. But right now, the market is expecting 3 rate cuts. And you can see, basically this is a sentiment index for Federal Reserve voting members and the FOMC. And when this number goes down, it tends to indicate a little bit more of a dovish signal. And so they are talking a little bit more dovishly right now. Current estimate, as we sit here in almost mid-May, is that we're looking for 3 25 basis point rate cuts at some point this year. So here we have inflation expectations, which, as I mentioned, there's definitely an offset to this whole rate cut expectation. Is you have rising inflation expectations, again, driven primarily from the tariffs. If we didn't have tariffs, that trajectory was definitely looking down, and it was trending down for a long period of time until tariffs came into the picture. And so it makes it really tough for the Fed to even internally commit to think about interest rate cuts when you have this kind of environment, because inflation's, in some cases, if it does condition behavior, it can be a self-fulfilling prophecy to some extent. And so this is the opposite side of the argument to us getting 3 rate cuts this year, is that as long as you have inflation expectations which are moving higher, it makes that a really hard thing for the Fed to do. Here we have downside risks to employment growth, not too surprisingly. Haven't really seen this in the data yet, but this is the University of Michigan in the blue line here. This is the expected change in employment over the next year, and you can see that that has gone decidedly negative at a time where monthly change in non-farm payrolls, again, like I said, the labor markets had some resiliency to it, but the degree to which, going back to the beginning of the century here, that you see a real tight relationship in this data, in these 2 data series, kind of tells you that this has to be reconciled somehow. And the theory, or I guess the conventional wisdom, if you will, is that labor activity and non-farm payroll growth will actually go down to match this level of expectation. Now we have consumer credit, which did go up in the latest reading. In fact, it was a little bit higher than expected, but we were thinking that it was going to be fairly robust. This is an annualized rate for monthly data. And you can see here that it spiked up, and I think in large part, with expectations that we're going to have higher tariffs, and so people, kind of went on to revolving credit to ramp their purchases, because to get these things before the prices go up because of the tariffs. But the one thing that really caught my eye in the research here is the fact that consumer credit as a percent of disposable personal income and as a percent of gross domestic product, or GDP, has and continues to go down. So net debt levels at the consumer level even though we've had some recent spikes in consumer credit, it's not a problem yet because we see the percentages as the levels as a percent of personal income and of the overall economy are both trending down pretty aggressively. We're talking about personal bankruptcy filings. Again, if you always monitor this if you feel like you're on some kind of a slowdown, the precipice of an economic slowdown. Well, yes, in fact, since 2022, we have seen kind of a gradual rise in the amount of personal bankruptcies, not corporate, but look at on a relative basis where we are here. You got to go back, this is pre-pandemic. And so this is exceptionally low right now. Even though it's moving in an adverse way, it's still exceptionally low at the point at this juncture. So we have retail inventories, which I want to say something about. Here, we've seen a gradual rise in inventory levels, but when you look at this is the inventory to sales ratio. So the IS ratio, as they call it. So it's how much inventory do you have relative to your overall run rate level in sales. And so you can see that inventory, for many, many, many years ran at basically about 1.5 times your sales level. Well, that is now 1.3. Even though it's gone up, it just means that the shelves have you're at risk of emptying your shelves a lot sooner because of tariffs and trade slowing down, so on and so forth, because you just don't have as much inventory for every dollar of sales that you're generating. Here we have imports of goods. We talked about this before. We've got excess imports ahead of the tariffs, just as we talked about. This is on billions of dollars. So you can see that's a pretty important change here. And then just to emphasize the point in that last chart that basically days of inventory are trending down. They are higher than we've seen lately. But again, this number continues to move lower. It just means that your shelves empty out a little bit faster. We talk about productivity going down. Now, this is a new development. Productivity helps to keep a lid on inflation. And productivity goes down when you have like major kind of economic dislocations like the expectation of tariffs. We have labor costs that have gone up. But again, the overall unit labor costs are not like egregious in the sense that, certainly not where they were at the height of the inflationary environment, but they do and have remained sticky. So this is a dynamic that you definitely don't want to see affirming itself over time, that you have declining productivity and unit labor costs that are moving higher. So this is another way of looking at productivity, and you can see that's moving lower. So this is basically, on a non-farm basis, business sector output on an hourly basis here, and you can see that yearly change, that is pretty much in line. So nothing remarkable in this data series, but in this one, when you look at it in terms of its aggregate level, I mean, it's not an outlier, but again, when you start to see decelerations in your overall level of productivity, it could change the outlook for labor and hiring intentions and things like that. So quick note on the housing sector, we've got home buying intentions, and there are two different data series, and I'll hit the left after I hit the right here, and you can see these are both Gallup polls, and it's like, is it a good time or a bad time to buy a house? And you can see, the good time has really gone down, even though it's, a little fish hook up here, but it's still very low, extremely low. Whereas bad time is extremely high, even though it's come off its peak. And so when you look at like that one, that's pretty telling. But when you come over here and you say, listen, in the next 5 years, like this is just like this has a timing element to it, but this is a little bit more specific. Are you going are you likely to buy a home in the next year or the next 5 years? And you can see that that's gone down from 50 to 30. So that's pretty intentional and a pretty dramatic shift. This slide, we have 30-year mortgage rates, which despite some of the volatility we've seen in the 10-year yield for the Treasury, that these rates are holding in here just below 7 or around 7% right now. Current rates are about 6.8%. On this chart we have from Wallet Hub, what they call their economic indexes, and essentially the output from surveys and talking to consumers. And just going to reinforce a point we're talking about, like for home purchasing intentions, say, what's the likelihood of making a big purchase or buying a home or buying a car? And you can see that those intentions have gone way down here. And, these are big ticket items, and they tend to move the economy a little bit more than smaller ticket items do. Overall economic index, as they're showing, as they define it, is down. Now we have some positive areas like, stress level about money. That's actually a positive takeaway from this, and positive sentiment about employment. So speaking to the stability of the labor market, and then confidence in having a job, that's actually positive. So some interesting takeaways here, that there is some level of confidence, even though people are getting a lot more conservative, and particularly in finances 6 months from now, with the uncertainty with tariffs and debt levels and potentially even credit scores. Interesting, on this chart, we have international air passenger travel, with all of the, the tariffs out there and the retaliatory tariffs and all the rhetoric and negativity that's going on right now. We've seen about 500,000 passenger decline on a, basically on a year-over-year basis. And so that so far has been the impact, is at least one view of the impact here is just travel international. International travel has gone down. On this chart, we have kind of an indication of what businesses are seeing, some higher costs. These are non-labor payments in the non-farm business sector. This is on a seasonally adjusted basis. You can see that the latest reading here is a little bit up, and they have been up for quite some time. This reflects the inflation that we saw and the progress that we made, and now those costs seem to be moving a little bit higher. So there's some evidence there that businesses are seeing a little bit higher costs already. So we've already talked about unit labor costs and how it remains a little bit sticky. Wages are higher. You can see here on this amber line, this is informative that even though you've got real compensation per hour in the non-farm business sector, which continues to move higher, which it should, because inflation is a part of this as well. But you can see that the rate of change, the growth level, is actually slightly negative at this juncture, and you can see that deceleration probably is going to continue looking ahead into the next few months. Now we have household income growth expectations, and we've shown you this in prior weeks here. It was sentiment kind of turning negative. We see this also going in the adverse direction. On this chart, we have a New York Fed survey of consumer expectations. And again, to dovetail with the last chart about income expectations, we have in the black line here a survey where people are indicating somewhat worse off. And you can see that number is going up. And then much worse off is down here. And so you can see that that's moved higher. And if you get past the pandemic, you can see these levels were a lot lower. And so again, this is soft data. This is expectations. This is not like hard observable data. These are kind of like sentiments. This is like a response to a survey and what people are saying in response to the question, that they're obviously a bit more worried. Here you have consumer expectations of one-year household income growth. And this is what we saw in the last slide. So we know it's moving lower. And then mean probability that unemployment will be higher in a year. And so not too surprisingly, when you see that one moving down, you ought to see that one moving up. So again, these are soft data items, which we know have been soft predominantly over the last month or so. So interesting data point here. We've got basically, World War II, and even, the advent of the energy sector. We had manufacturing employment. Again, this is the aggregate. Like we had at our peak almost 20 million people employed in manufacturing at one point in time, and that number has gone down. But this is on an aggregate basis. So these are just like, aggregate number of jobs. What's really impressive here, if you were to overlay the number or the aggregate of manufacturing jobs as a percent of the total labor force, I mean, that trend looks way down. So again, like we always talk about, manufacturing is important to this country, but services are much more important. Here we have global debt levels, and I want to point this out because we did hit a record in about $325 trillion across the globe. And you can see in this little blue sliver here that a lot of it came from government issued debt. Now, a lot of it came from non-financial corporate entities around the globe. But then, if you look at these two items together, it paints a pretty impressive picture as far as the rate of growth. And you can see here that households have been pretty, again, across the globe have been fairly frugal and not getting out of line too much. And you can see that financial corporates are pretty much consistent. It's just these two areas that have really blown out to put us on that record trajectory here. We've seen some pretty impressive money flows into the equity market, and you can see cumulative flows to U.S. equity funds since really before the global financial crisis. We're talking about, basically well over $1 trillion. Now we have the S&P 500. We've got the change in quarterly earnings. You can see here that again, the average, or I guess not the average, in this case is technically the median going back to 1935 is 11%. So we're very close to that. This is year over year quarterly earnings. You can see that the proportion, though, of those companies that are beating their margin estimates, not earnings, but margins, is falling a little bit. So this is obviously something tying back to tariffs and the ability to pass through costs, et cetera. Companies' ability to do that, at least the proportion seems to be declining, even if our year-over-year earnings rate is somewhat consistent with long-term averages. So short interest is very high for the Russell 2000, which is not surprising because you've got a fairly decent percentage of the Russell 2000 companies, the constituent companies, they don't even make money. So when you are staring at a potentially slowing economic environment due to tariffs, it's certainly natural to think that more of these companies in the Russell 2000 might be under stress, and therefore your short interest is moving higher. Monthly change in credit spreads. This is very noisy here, but you can see that secured loans and high yield bonds. I mean, obviously 2022 was a very tough year for credit, and we do see that these spreads are moving higher. But again, we've talked a lot about maybe introducing more private investments that have less volatility embedded, and you can see that in this amber line here, that these change in credit spreads has actually been fairly muted for private credit relative to other forms of publicly traded credit. So we're talking about spreads as well. And so, we've been dealing with a really tight spread environment. I mean, very unusual. And, at times where, like even in 2022, when we felt like, we were going to have, and we did, in fact, have a pretty meaningful kind of, change and thought process as far as credit goes. And we did see kind of a bump here in bond spreads, but it wasn't really significant at a point where you thought, okay, if we're going to go into a recession, these things should be much higher, but they weren't. Now they went back down. You can see that they're moving higher now too. And again, just like we've seen in other data series, that there is a pretty decent relationship here, between economic policy uncertainty, which is in the blue, which obviously, as we know, has gone through the roof here, and then bond spreads. But what we haven't seen is the catch up or the correlation here. So I'm not saying that bond spreads are likely to blow out. I'm just saying that under normal circumstances, you would have higher spreads on more risky fixed income. So we're talking about earnings a few minutes ago. Here is kind of the post Liberation Day, if you want to call it that. That consensus forecasts are clearly moving down. So what we have here is the second quarter of 2025, which is expected to be fairly low, and then third quarter of 2025, which estimates are also going down, but the estimate level here is oddly high. It's still like 9% at the moment, and as I showed you in that earlier chart, that may be the quarter in which we experience perhaps the most economic stress overall. So it wouldn't surprise me that these estimates come down a lot faster near term unless we start really cutting some trade deals with people. Estimates, again, talking about estimates here for the second quarter, as we just talked about, they've been cut pretty sharply, which I think is a good thing. They may still have, some room to go, and I do think the market has really kind of priced this in a lot. And you can see where it's coming from since the start of the first quarter reporting season, which was really about call it 3 weeks ago. Energy, consumer cyclicals, which is not surprising, materials and industrials have seen really kind of the lion's share of some of these negative earnings estimate trends. This chart, we have another sentiment indicator. This is investor sentiment from the American Association of Individual Investors, and we've talked about how this has been very, very bearish for quite a while. And just lately, we've seen a little bit of a positive uptick. It's still negative, but it's a little less negative than it has been. Here we have the percentage of the S&P 500 members that are establishing new 12-week highs, and that's a pretty low number right now, only 6%. So we don't have a lot of high flyers here, and but we do have a little bit more breadth in the market that we've seen in a while. We just don't have a lot of firms that are making new highs just yet. This is another chart which gives me some comfort. When you're looking at how to navigate some of this uncertainty, you tend to always focus on quality, companies that have strong balance sheets, that have strong cash flow, that have the wherewithal to either pay dividends or, in this case, buy your own stock back. And you can see here, that we've seen a multi-year trend in increased stock buybacks, but that trend has been well reinforced this year to date. Even with all the uncertainty, companies are willing to step out, use their free cash flow to buy back their own stock as well as pay dividends. And those are the kind of companies that are going to be much more resilient in this environment. That's all we have for this week. Hope you've enjoyed the chart pack, and have a great week, and we'll talk to you again soon.